Welcome back to Investing Talk Podcast. Today, we're taking a really close look at a company quite a few of you have asked about, Aurora Innovation. And the big question we're trying to unpack for you is pretty straightforward. Is Aurora Innovation a good time to buy right now? We'll be sifting through, financial reports, analyst views, all that stuff to pull out the key insights. The goal is really just to help you feel well-informed about this particular stock. And hey, before we dive in, a quick ask. If you find this kind of analysis valuable, please hit that subscribe button, maybe like the session, and leave us a comment. It honestly helps us a ton. And if you're feeling generous and want to support our work, you could consider buying us a coffee. Also, really important, if there's a specific company you want us to dig into next, just let us know in the comments below. Okay, let's get into it. Starting with the core financials for Aurora Innovation. So when you start looking at the fundamental health, what are these raw numbers telling us? We've got Q2 2025 revenue, just $1 million. And earnings are deeply negative. We're talking EPS of $-0.11, trailing net income minus $810 million. And the forecast for the full year is $-0.48 EPS. What's the immediate takeaway from figures like that? Is there any positive spin on them beating estimates by just a penny in Q2?
Well, what's interesting here, I think, is that while, they are clearly unprofitable, that small reduction in cash burn is a notable sign. For a growth-focused tech company like this, it's something. Think of it like they're burning fuel like crazy, but maybe they found a slightly more efficient way to burn it. It hints at some operational efficiency gains, which the market likes to see. But let's be clear, early-stage autonomous vehicle companies, they all operate at huge losses. It's because the R&D spending is just monumental. So the numbers are alarming if this were, say, Coca-Cola, but for Aurora. It's more about the trend. Is the cash burn slowing? That's the key signal people look for, even if profitability is miles away.
Right, so the trend is slightly better, but they're still using a lot of cash. $286 million for operations in just the first half of 2025. Okay, that's down from $326 million the year before, but wow, that's still a massive outflow. For a company bringing in only $1 million in revenue, how significant is this improving cost management, really? And what about the fact they have no major debt? They seem to rely on equity financing and cash reserves. How does that play into their runway?
That's a really critical point. That ongoing negative cash flow, it means constant dependence on external funding, literally just to keep operating and developing.
Yeah.
And that, often means potential dilution for shareholders down the line if they issue more stock to raise cash. The lack of major debt, it suggests they prefer equity, avoiding interest payments, sure. But it puts huge pressure on them to perform, to keep investors believing and willing to put in more capital. Now, competitively, their focus is this Aurora driver platform. Scalable, they say. But honestly, they're in a tough spot. You've got Waymo, Alphabet's company, with millions of real-world miles. You've got Tesla using its whole fleet for data. Aurora's challenge isn't just building the tech. It's proving it's better or faster or somehow uniquely positioned. And the specifics on their tech differentiation and their IP, it's not always crystal clear in the reports. That introduces, execution risk. Can they scale? Can they beat these giants? All while burning through cash. That's the gamble. And yeah, that tiny revenue base for their market cap just screams early stage. Traditional valuation is almost meaningless here.
Okay, so that leads perfectly into the next bit, which often trips people up with these kinds of companies. Valuation. How on earth does the market value this? Their trailing price to sales ratio is, it's 11,790. How do we even start to interpret that? Negative earnings, no dividend. It feels impossible to use normal models like DCF.
You absolutely nailed it. That PS ratio isn't really a valuation in the traditional sense. It's almost pure expectation. Faith, maybe. It implies these incredibly bullish assumptions about the future, like massive market share, huge adoption, things that haven't happened yet. So connecting the dots, this isn't about today's fundamentals at all. It's purely about the long-term dream of autonomous driving and Aurora's potential slice of that pie. It's a bet on a future that's still very much being built.
And yet, despite these, let's say, challenging numbers, analysts seem quite optimistic. Average price target $10.25, suggesting over 60% upside. How do we square that bullishness with the current reality? And then there's the stock's behavior. Super volatile, right? Trading between $6 and $7 recently. But the 52-week range is huge, $3.40 to nearly $11. Plus, a high beta, $2.50. What does that volatility and high beta really tell you as an investor about how the stock moves?
Well, those analyst targets, they're basically built on those same long-term projections we just talked about. They model scenarios where everything goes right. Commercialization happens, adoption takes off, Aurora wins big. It's a future-looking optimism, not based on today. As for that beta, 2.50. Yeah, that's not just a number. It tells you the stock is like strapping yourself to a rocket. If the market goes up 1%, Aurora might jump 2.5%, but if the market drops 1%, Aurora could easily fall 2.5% or more. It signals huge volatility, a lot of speculative interest. It's definitely a higher risk play compared to the broader market. And those technical levels support near $6. Resistance around $9, $11. There are zones where price might react, sure, but they're mostly driven by news, by sentiment, not really by fundamental shifts yet. It's very momentum sensitive.
Okay, let's shift gears a bit from the numbers and look at recent news and sentiment. We talked about the Q2 report, marginal beat, slower cash burn. But besides that, what other news or maybe analyst actions have been moving the needle for Aurora lately? The consensus seems to be buy, but you mentioned the source notes a lack of major new product launches or partnerships in that report.
That's right. The reason positive buzz has mostly been about hitting those slightly better than expected earnings and showing that improved cost management. It's that incremental progress rather than some game-changing breakthrough that seems to be underpinning the analyst optimism. Baby steps, maybe.
Yeah.
But yeah, beyond that, there wasn't a huge announcement of a massive new commercial deal or a big regulatory win in the latest updates. It feels more like steadying the ship.
Okay. So incremental improvements are the main story. What about the broader feeling around the stock? The source mentions social media and retail investors being pretty speculative, really liking tech stocks with a big potential market, that TAM concept. What is that speculative vibe combined with apparently no major insider buying or selling? What does that tell us about how the market views Aurora? And then looking forward, what are the key things, short-term or long-term, that could actually make a difference for Aurora stock?
Yeah, that raises a key question, doesn't it? What actually drives success and price for a company like this? That retail sentiment, focus on TAM. And it's very common. The sheer potential size of the autonomous driving market is seductive. It can sometimes make investors overlook the immediate hurdles, the cash burn, the competition. It's the dream big narrative, the lack of significant insider trades. It's kind of neutral, really. Doesn't scream confidence, but doesn't scream panic either. Maybe insiders are just holding steady. Doesn't give you a strong signal either way. Catalysts, short term. Definitely the next earnings report, October 29th. That could cause big swings. Any further narrowing of losses, or better yet, news on actual tangible revenue streams starting up. That would be big. Also, any news on new partnerships, or real significant ones, or regulatory milestones like expanding pilot programs. That matters, long term. It's all about progress towards actually commercializing the Aurora driver at scale. That's the holy grail. Plus broader regulatory shifts favoring autonomous vehicles, expanding partnerships, and maybe even M&A activity, either of them buying someone or getting bought. Those are the real value drivers down the road. Without those, it's still just potential.
Okay, so let's try and pull all these threads together. We've got the R&D costs, the sky-high valuation, fierce competition, cash burn. What does it all mean for you, the listener, if you're considering investing? Can you break down the key risks involved here?
Absolutely. There are definitely layers of risk. First, the company-specific stuff. Top of the list, still no profit and burning through cash heavily. That requires constant funding, which, as we said, could dilute existing shareholders. Then there's the whole regulatory maze. Autonomous vehicle laws are still being written. They vary everywhere. That's a big hurdle for widespread deployment. And the competition, it's intense. Rapid tech changes mean they have to constantly innovate just to keep up, let alone get ahead of rivals with very deep pockets. It's a tech arms race, basically. Beyond Aurora itself, you've got market and sector risks too. The tech sector generally can be volatile, and Aurora's high beta means it gets tossed around even more during market swings. Like we said, it amplifies market moves. Economic downturns could also make it harder for growth companies like Aurora to get the funding they need. Access to capital isn't guaranteed. And finally, public perception matters hugely. Any safety incidents involving self-driving tech, even from competitors, could impact public acceptance and slow down regulatory progress for everyone. So putting it all together, the investment thesis is basically this.
Aurora offers speculative upside. It's a pure bet on autonomous technology taking off. That's why we'd lean towards maybe a 5 out of 10 rating overall. Why only 5? Well, despite the analyst optimism and some momentum, you just can't ignore the lack of profit, the cash burn, that really wild valuation, and the execution risk. It's a tough field. The risk-reward is skewed towards high risk. The reward is potentially huge, but it depends entirely on transformative adoption and them executing perfectly. So who is it for? Probably better suited for a long-term investor, someone willing to stomach a lot of volatility and closely watch their progress. Short-term trading. You might see swings on news, sure, but it's super risky. Really only for speculators with strict risk management. High tolerance for potential losses is a must.
Okay, so the bottom line really seems to be Aurora Innovation is a classic high-risk, high-reward situation. It's a significant bet on the future of autonomous tech, and it demands patience and really keeping a close eye on their actual progress, commercialization, regulations, the whole nine yards. So as you consider Aurora innovation, maybe the question to ask yourself is this: how much of that future potential do you think is already baked into today's price? And how much are you willing to wager on self-driving technology really, truly becoming mainstream? Thank you so much for joining us for this look into Aurora innovation. And please don't forget to subscribe, like this analysis, and drop us a comment if you found it helpful. Your support honestly means the world. And remember, if there's another company you'd like us to tackle, just mention it in the comments. Until next time, keep learning and stay informed.